Trading losses are something that every trader or investor will experience sooner or later. But how one manages those losses will determine whether or not they will profit in the long run, or whether they will spiral out of control, leading to eventual blowout of their account. George Soros, one of the legends in the trading world, once said that, "It's not whether you're right or wrong that's important. It's how much money you make when you're right and how much you lose when you're wrong." This quote emphasizes the fact that every single trader or investor out there will lose money eventually. There is no such thing as a 100% profitable trading strategy. Trading losses should be looked at as a cost of business, where you incorporate it as part of your trading plan. Failure to account for how to handle consecutive losses is usually the most common mistake for beginner traders and investors. But as human beings, we are not programmed to deal with losses. In fact, the psychological impact from experiencing losses is much greater than the joy of winning. This is true when you examine how most of our life decisions is all about avoiding pain and losses. Even our education system stresses this fact that you should always avoid the wrong answers or be punished with low grades or scores. No wonder that most traders or investors lose in the long run. We simply behave the way that we are taught growing up. So now that we can acknowledge our shortcomings with regards to handling losses, how do we go about in minimizing this negative psychological trap? The first step is to always create a trading plan. A trading plan is necessary to help the trader stay focused on the tasks at hand. A trading plan must be detailed enough to cover all aspects of the trading approach, from entry and exit rules, to how they will document their results for future improvements. I have made a video on how one should create a trading plan, so please take time to watch that video before you get started in trading. A trading plan is useless without a proper focus on the most important aspect of any strategy: risk management. Proper risk management will undoubtedly help you overcome fear of trading losses. Determining your risk management rules depend on a few factors. First, you need to understand how your strategy has performed in the past. This information about past performance is important, because you will need to know how often your system goes into a drawdown period. Generally, I would advise risking only between 1/4 to 0.5% of your account on each trade. Sure, it sounds small, but as you get better you can always slightly increase the risk to 1% or more, depending on your level of comfort. Personally, I usually risk 1/4% per position in a trade, and just let the power of compounding do its thing. Backtesting your strategy over a significant sample size will help you determine what level of risk is appropriate for the drawdowns you will inevitably experience. Risking too much is the #1 reason why most traders fail. Let me repeat that. Risking too much is the reason why most traders fail at trading. Let me repeat one more damn time. Risking too much is the reason you lost so much damn money and why you blew up account after account. Anyway, once you have defined your trading plan and have determined to use small risk for your trades, the only thing left to do is just focus on the process. According to Jack Schwager, one of the leading trading book authors, said that the hard work in trading comes in the preparation. The actual process of trading, however, should be effortless. Discipline is required to be successful in any endeavor, and trading or investing are no different. Your detailed trading plan is of no use if you cannot adhere to the process and execute your trading strategy to the T, without deviation. This is one of the reasons that I don't really believe in a discretionary trading approach. Your trading needs to be methodical, executed free from opinions and negative emotions. If you constantly breaking your rules, or unable to follow your strategy time after time, you got some serious issues to deal with before you even think about risking money in the markets. So remember, trading is not easy. And as human beings, we don't deal with losses easily. I hope that the tips I shared in this video can improve your ability to stay consistent and avoid some of the common psychological traps resulting from trading losses. As always, it's important to always perform weekly or monthly reviews of your trading results. This includes noting down how you felt during your trades to identify any mental triggers that can negatively impact your trading performance. Anyway, that's the end of this video. If you find these trading tips helpful, please leave a like and subscribe to this channel for more content like this. Later.